We know it sounds crazy. We know it sounds irrational. But history says the low may be in, stocks could continue to rally, and drawdowns may be muted. Quick recap, because this slide applies in a big way to the analysis that follows. Charts are a reflection of human behavior. Humans tend to act in similar ways during periods of high stress and fear, when they are fearful of being left behind, during a bottoming process, and at the early stages of a new bull market. That all sounds great. Can you show it to me? The answer is yes. It's right here in front of you. This goes all the way back to 1950. This is the S&P 500 7-week rate of change. You might think in the present day what we've seen in the rearview mirror is insane, and there's no possible way that it could be part of a long-term or lasting bottom in the stock market. This chart here tells us to keep an open mind about that being the case. Only 5 times in the last 70 years have we seen a 7-week rate of change on the S&P 500 similar to this. Number 1, number 2, number 3, number 4, and number 5. In the 4 previous instances, instead of being insane behavior, all of it occurred near a major low. 1975, 1982, 1998, 2009, and number 5 is this week, Friday, May 8th, 2020. Therefore, it might be helpful to know what happened in each of these cases. February 14th, 1975 is similar to Friday, May 8th, 2020. A, the low was in the rearview mirror. B, the maximum drawdown looking out 6 months was very, very small, under 3%. And the additional gain walking forward, 72%, and that does not include the V move off of the bottom. Everything that we just said about this chart applies to this chart in 1982, September 24th, 1982, very, very similar to Friday, May 8th, 2020. Muted drawdown walking forward from this date, very, very satisfying gains, additional gains. Doesn't include the V move off of the bottom. 1998, similar situation. November 27th, 1998 is similar to the present day. Relatively muted drawdown. The additional gain walking forward, almost 30%. Very, very rare. This point here, May 8th, 2020, similar to this point right here. April 24th, 2009. Relatively muted drawdown, less than 2% walking forward from that date. Gains into calendar year 2011, an additional gain. Does not include this big irrational move off of the low. The additional gain was 57.42%. None of this predicts anything in the present day, and it really doesn't matter because we trade the chart in front of us. This chart helps us with something that's very, very difficult to comprehend, that the low could be in, A, and B, that really, really good things could happen for a long period of time. Anything else to help us keep an open mind about the concept that the low could be in the rearview mirror and that good things could potentially happen for a long period of time? Yes. NYSE stocks above the 200-day moving average is a monthly chart as of month end, April 30th, 2020. 2 things here. This is a very rare oversold level. You have to get below this dotted line. And number 2, you have to have some sort of a breath thrust in 1 month. Rate of change right here, rare to hit this point. Hit it here, hit it here, hit it in here, but we didn't hit the oversold level in this case. Doesn't count. We need both. Hit it here and hit it here. April 30th, 2020 is similar to this point here, this point in here, this point in here, and this point in here. What happened in the S&P 500 walking forward? The answer is really good things happen for a long period of time. Looking out 2 weeks to 5 years. How about a drawdown? Also relatively muted. For the most part, in 3 out of the 4 cases, the market never looked back. In one case, there was an 8% drawdown, and then after that, really good things happened walking forward for 4 to 5 years, telling us to keep an open mind about a wide range of outcomes and reminding us that a relatively significant pullback, even under a bullish longer-term scenario, could be in the cards. Small Caps Weekly, this is during the session on Friday, May 8th. Hard to make an argument that that's an ugly-looking weekly candle. SCHG relative to TLT, growth stocks relative to long-term treasury bonds, this looks like somewhat of an inverse head and shoulders pattern with a breakout above the neckline. This chart is dated Friday, May 8th, 11:24 a.m. Respecting that anything out of China needs to be taken with a grain of salt, but you can pause your video player. This is interesting relative to consumer behavior. This is being recorded after the close on Friday. We have our first weekly close above the 100-week moving average since this event began. Equal weight technology, RYT, relative to SPY. Consolidation, a breakout, cross above the zero line on the weekly MACD. You can make an argument that this setup in here, after this really good things happened, similar to this setup in here, this cross here, similar to this cross in this area here. Stocks versus bonds, May 8th, intraday, 11:30 a.m. This is potentially a significant development on the weekly chart because we're back above this low here from Christmas Eve of December 2018. Similar situation here, this big gap here from 2016. When we got on the other side of the gap here, this ratio, stocks versus bonds, SPY, TLT, ran in an impressive manner for a long period of time. This week, this is an intraday chart, 11:34 a.m. Eastern Time, May 8th. This is a constructive look here. You can pause your video player. Remember the article on April 6th that we said subtle shifts in the market can provide information. Here, before the final low in the S&P 500, where my cursor is, this is January 6th, 2009. Really bad things happened in the March 9th of 2009. Notice this breadth indicator stays for the most part below the orange and blue line. When good things start to happen here and the low is in, we get above it. Present day, we are above it. Friday, May 8th, NYSE Composite Weekly. You can make an argument this is a bullish breakout and a retest and a higher high. We are now above the Christmas Eve low here. Wouldn't it be great if the value of our investments was determined by our own personal opinion 100% of the time? When we phrase it that way, it sounds almost silly. And we do know that in the real world, the value of our investments is determined by the net aggregate opinion of all market participants regarding all subjects on all time frames. So let's take a look at the data and ignore the noise. AII Sentiment Survey, Thursday, May 7th. Highest pessimism in 7 years. Seems to align perfectly with the statement from last week's video that the bearish case is well covered and easy to understand. And in this present-day context, it remains fair to say that for the average investor, the bullish case is harder to understand and comprehend. S&P 500, March 23rd, 2020. At this point, the chart in front of us and historical precedent favored bearish outcomes. But on April 6th, things began to change, and the chart in front of us told us it was prudent to shift our probabilities relative to a wide range of scenarios. And the look of this chart on March 23rd and the look of the same chart on April 6th gives a real-world example of all of the concepts on the screen here. If we're trading the chart in front of us on April 6th, then it's much, much easier to begin to shift out of this mindset. which speaks to thinking in probabilities. And if we take this chart and fast forward to May 7th, we still have an intermediate term or short-term bullish trend. And despite that, we're still in a situation where most investors are highly skeptical. As we noted in this April 6th post, this subtle shift here was important. Just as this study here that we covered in the April 10th, 2020 video helped us remain open to a wide range of outcomes, even outcomes that are difficult to comprehend. The same can be said for this study that was published on April 14th. And I think it's fair to say, given that we have the highest pessimism in 7 years, that anything that approximates what's reflected in this table here over the next 2 weeks to next 5 years, anything close to that is going to be very, very difficult for the average investor to comprehend at the present time. And if you've been in the markets for a long time, you could have said the exact same thing in October of 2002, March of 2009, October of 2011, February 2016, and January of 2019. And yet, this is what happened walking forward in each case. The historical context is extremely important in terms of helping us think in probabilities. Be the first one to admit, something like this walking forward seems somewhat outlandish at this point. Do we have anything else that would align with better than expected outcomes over the next 2 weeks to 5 years? You can make your own call after reviewing the charts that follow. It's a daily chart of IWM small caps. Only 2 times in the last 13 years has this happened. Come down to this blue line here, 31 session rate of change, and make it back to this green line here. Never happens in here, never happens in here. It just happened here. This first spike happened before the final low. This happened after the final low. Given this is a big drop here, we would like to try to discern between this point and this point. This is right around January 6, 2009. This is after the low. This is March 9th of 2009. The outcomes are significantly different from this point here and this point here, something that's reflected in these 4 scenarios. And keep in mind, this is not just lines on a chart. Every chart that we're about to cover is a reflection of human behavior. Is there any reason to believe that small caps could rally in a manner like this walking forward? Over the next few sessions, a chart like this can help us assess those probabilities. This is IWM divided by SPY, Thursday, May 7th. This is RSI down here. You can see the ratio tried to break out here. We either have a failed breakout or we're retesting this breakout. This divergence here with RSI tells us to be open to a move in this direction. We don't need to guess what's going to happen with this chart. We just need to monitor this chart. High-yield bonds relative to treasuries, JNK relative to IEF. Similar situation here. Chart goes back to 2008. The only time previously that we saw a swing from this level here to this level here on the 32 session rate of change, 2009 and 2020. Regardless of whether the final low was in, this look here tells us we should at least be open to a bottoming process. But very, very similar to the last series of charts, this outcome here from about January 6th is radically different from this outcome here. And right now, this ratio in the present day has something to prove. This is the NASDAQ 100 on the bottom of your screen. The NASDAQ 100 has exceeded this high here. This ratio is making a lower high. How might this chart help us assess probabilities walking forward? If we're trying to assess the probability of the present day looking more like January 6th, where bad things happen, or more like April to May, where good things happened, It's helpful to understand how these ETFs moved before the final low and after the final low. This is JNK in red, IEF in blue. This is a performance graph. So between January 6th, it's a counter trend rally high in the S&P 500, then the S&P 500 falls into March 9th. Over that period, IEF outperformed JNK by a wide margin. IEF only lost 2%, JNK got hammered, lost 21%. This look here aligns with this move here. If March 23rd, 2020 was a major low, how might we expect these two ETFs to perform walking forward? In the present day, the major low is in the rear view mirror, about 31 or 32 sessions. So the proper way to compare it is to walk forward from a similar point after the March 9th low. That would be April 23rd. Notice the difference in the performance of these ETFs. They flip. Here, JNK gets hammered relative to IEF. Here, JNK hammers IEF. Therefore, this look and this look can help us with the present day chart over the next few sessions and or few weeks. Nothing definitive about any of this. Simply helps us assess probabilities using a weight of the evidence approach. We never make decisions based on one chart or one ratio or one indicator. Always make decisions based on the weight of the evidence. You can see in this case, we're not trying to forecast what happens on this chart. We're trying to understand what could happen, what that might mean from a probability perspective, and how we might react in each case. Is there anything else that we can use in the present day to try to discern between this period and this period? Yes, the VIX. Early January 2009, the VIX had a big spike up. After that spike, the S&P dropped an additional 17%. This is the lowest level that the VIX hit here on April 23, 2009, which would be similar to the right side of the screen here. Thus, in the present day, we can learn something about probabilities based on where the VIX sits relative to these positions here. Down here would lean bullish for the S&P 500 and after the major low. If we're up in this region here, it would align with the probabilities that the low might not be in and a lower low may be coming. The present day level on May 7th is roughly the exact same area that we were on April 23rd, 2009 after the major low. And you might be saying, why do you keep comparing the present day to 2008 and 2009? We didn't pick these periods, the data picked these periods. This is the VIX in the present day. This is the only other time in VIX history where something like this happens. On all of these charts, the data is picking this period here. We are not arbitrarily choosing to compare the present day to any period. Anything else? Similar concepts here. You can pause your video player. This is 1 over the put-call ratio, but we're looking at the 22-day moving average of the put-call ratio. You can think of it this way. Readings down here tend to be associated with higher fear, readings up here, lower fear. We just moved from this line here above this blue line. The only other time that's happened is right here. This chart also aligns with after the low. This looks like April 23rd, 2009. This is the highest that we got in 2008. We've exceeded it in the present day. Also notice conceptually, when this ratio gets extremely low and then rallies into this area here, it's low, rallies into this area, low, rallies into this area, low, rallies into this area. In these cases, from a longer-term perspective, good things happened in the S&P 500, good things happened in the S&P 500. Wall Street Journal title, Stocks Keep Rallying Despite Lack of Visibility on Economy. From this article, disagreement among analysts has soared with the dispersion of estimates for the S&P 500 company earnings over the next full fiscal year reaching the highest level in March of this year since May of 2009. When was the last time we had very little visibility relative to the economy like this? After the major low in 2009. Similar concepts here. Value line, geometric index, only 2 times since 1980 have we moved from the lower blue line on the 1-month rate of change to the upper blue line. This is not a bunch of lines on a chart. This represents a major shift in human behavior, a rare shift in human behavior. Can't find a move like this anywhere else on the chart going back to 1980 except the present day. Here we are in the present day. This here occurred after the major low. Similar situation here. We're looking at the yield on the S&P 500 relative to the yield on a 10-year Treasury bond. Only 2 times dating back to 2008 have we seen a move like this, from the lower blue line to the upper blue line. The lower blue line to the upper blue line. This is a shift in human behavior. This is a shift in human behavior. This tells us to keep an open mind about a bottoming process or a bottom. This is February 6th, 2009. Been doing this a long time, and I know when people look at a table like this, they're saying that's absolutely ridiculous. There is no way something like that could happen walking forward. I can remember people saying the exact same thing in April of 2009. This is TLT relative to the NASDAQ 100 dating back to 2004. Very similar concepts. Only 2 times have we moved from the upper green line to the lower green line, the upper green line to the lower green line. May of 2020 and April of 2009. April of 2009 occurs after the major low. The S&P 500 made the major low on March 9th of 2009. This was bonds relative to the NASDAQ 100. Now we're looking at the S&P 500 relative to long-term treasuries, SPY relative to TLT. Very similar concepts. A very rare shift in human behavior. The only time we've seen a similar shift, dating back all the way to 2003, is May of 2020. This point here is April of 2009. This is May of 2020. Similar concepts here, VGT versus TLT. Shift in human behavior, similar shift in human behavior. Extremely rare shift. Q1 of 2009. Gold mining stocks, GDX in the ETF world. 31 session rate of change chart goes back to 2006. Only 2 times has something like this happened. Move from the lower black line, hit the upper purple line. Never happens in here anywhere. Never happens in here. Only have data going back to this point here. Similar shift in human behavior from this point to this point. This tells us to be open to a bottoming process. This tells us it's possible that this breakout could be followed by a lot of volatility. But good things in this case still happened for GDX. Simply speaks to odds. This is physical gold relative to the S&P 500. Only 1, 2, 3, 4 times has something like this happened. 31-day rate of change hits this point here. Hits it here, hits it here, and hits it here. This is near the 1987 major low in the S&P 500. This is near the major low in 2009 in the S&P 500. This European financial crisis, major low here. The 4th case is the present day. When we look at this chart and every chart that we're covering in this week's video, let's keep in mind, every single one of these charts that we're reviewing is a set of facts, which is radically different from a personal opinion. If you've been in the markets for a long time, you know on November 20th, 1998, April 22nd, 2009, people were highly skeptical. If you showed them an analysis like this and a table like this at this point in 1998 and this point in 2009, most people would have said you're out of your mind. Doesn't mesh up with reality. A move like this, top blue line to lower blue line, only occurred 3 times in the last 30 years. No opinions here. These are just facts. This is 31 session rate of change for a diversified basket of bonds relative to stocks. Think AGG relative to SPY. If you know your market history, November 20th, 1998 occurs after the major low and after the retest. Similar concepts here, but we'll use mutual funds because the data goes all the way back to 1986. An extremely rare move here. Similar move, November 1998. Similar move, November 2002. Similar move, April of 2009. And a similar move here, 2011. S&P 500 here. Good things happened. Good things happened. Good things happened, and good things happened. Consumer Staples XLP relative to the S&P 500. This is a daily chart going back to 2004. These charts are a reflection of a shift in human behavior. Only 2 times have we seen a move from here to here. First one occurs in 2009, telling us to be open to a bottoming process. And a bottoming process is still bullish from a longer-term perspective. How does a bottoming process help us in the present day? A bottoming process tells us that if scenario 3 unfolds, a typical retest of the March 23rd low, that we should be open to buying stocks during that pullback. Some things that we'll be looking at walking forward. This is the equal weight S&P 500 RSP relative to SPY. This is a daily chart dated May 7th. Very, very similar to the chart of small caps IWM relative to SPY that we've already covered. Bullish breakout. Now it looks like a failed breakout. RSI is telling us to keep an open mind about the ratio moving in this direction. We'll learn something either way. Why would we watch something like this? Because after the major low in the 2002-2003 bottoming process, RSP exceeded the returns for SPY in an impressive manner. 108% to 82% during this period here. And after the March 9th, 2009 low, RSP, equal weight S&P 500, significantly outperformed SPY. If that is going to happen or something similar is going to happen in the present day, this chart needs to pick up the pace. It has not done so yet. This looked good here, but it was a false start. S&P 500 a week ago, May 1st, indecisive. We said we're basically hanging out here. Same chart, Thursday evening, May 7th. This looks a lot more constructive. It's a long-term period of consolidation here for gold GLD. Thus far, this bullish breakout is holding. You can pause your video player, but what this tells us is that investment-grade companies still have access to credit. Another significant development for the credit markets and thus the stock market. This tweet here speaks to this ratio here. Volume by price, the NASDAQ is holding above this key area here. If the market decides to backtrack in some type of retest, this area could act as possible support. May 7th, you can make an argument. The NASDAQ cleared the 50% retracement. This is a successful retest of the 50% level. This and this, successful retest of the 61.8% level. The fact that the NASDAQ is trading above the 61.8 tells us to keep an open mind about the S&P 500 possibly doing the same thing. This week we have traded above the 50% retracement on Monday, Tuesday, Wednesday, and Thursday. Still an indecisive look here, but nothing to put this trend in doubt yet. May 7th, NASDAQ weekly. This is the close here. This is a close here. Last 3 weeks, here, here, and here. All of them above this line. And we're trying to move away in a bullish manner. This is also a constructive look here. Notice we do not get this here. We stay below this line here. It's a weekly chart. The look of it on Thursday really doesn't mean a lot. Need to see how we close on Friday, May 8th. Here's an anecdotal example of home builders recapturing their 200-week moving average. Similar situation here, here, and here. Trying to print 2 consecutive weeks above the 200-week moving average for the home building sub-industry index. From Tom McClellan that tells us to keep an open mind about better than expected outcomes when we look at the money supply, M2 divided by GDP. These are the common retracements of this A to B move. This is the leveraged loan ETF, BKLN. What does leveraged mean? It means riskier for the most part. This ETF has recaptured the 61.8 and thus far is consolidating above it. Hard to make an argument that the volume profile in here is not constructive. We'll learn something either way here, if we hold above or if we fail to hold it. Energy index, spot prices, it's based on oil and natural gas. 2009, it holds here. 2016, near a major low in the S&P 500. Near a major low in the S&P 500. This is possibly a failed breakdown. This is very, very similar to a failed breakout. We know that failed breakouts contain information. It's possible that this also contains information. If we hold above this line, it tells us to keep an open mind about a move like this or a move like this. Goldman Sachs, disposable personal income is likely to register slightly positive growth for this year because unemployment insurance has been so robust. You can pause your video player. Pause your video player here. This is the important part of this article. U.S. population, some states have started to reopen. A potentially positive and early stage development here. From the Wall Street Journal, the recent jobless claim figures suggest the wave of unemployment caused by the pandemic could crest as soon as this month. Typically, when you see something like this on a graph like this, the low is already in based on history. Walking forward from March 23rd of this year, trading the chart in front of us has thus far proven to be extremely helpful. And that will continue to be the case for the balance of calendar year 2020. And the only way that we can do that effectively is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material, CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.